Hello, and welcome to our bi-weekly Understanding Markets video update. We are recording this on the afternoon of Tuesday, the 19th of April. I'm Hellen Dalton, a Senior Investment Manager here at Cantor Fitzgerald. I am joined again today by our Chief Investment Officer, David Beaton. Hello, David. We last spoke on the 5th of April, so what's happened in markets since then?
Well, since the last kind of update on markets, as you say, 2 weeks ago, we've seen continued volatility, particularly on the bond market, and that has weighed on equity market performance over the last 2 weeks. I think if people recall back to the last update we gave, we did caution that the volatility that we'd seen since the start of the Ukrainian war, the move higher in inflation, more hawkish central bank commentary, were all going to act as headwinds to markets for the foreseeable future. And that's played out. We've seen European markets fall by about 2.5%, obviously more in the front line of the uncertainty surrounding Ukraine. But equally, we've seen US markets come back by about 2% on the S&P, and the NASDAQ, in fact, has fallen by about 6%. And that ties in with a significant move higher in bond yields since the last update. I mean, the yield on the US 10-year, just to give our listeners a kind of context to this, back on the 5th of April was 2.56%. Just before I came up to do this video update, the yield is now at 2.91%. So we've seen a 35 basis point increase in the 10-year yield, and the 2-year yield is broadly flat. So the inversion that we spoke about in the yield curve previously, that has now disappeared. We've now got longer dated bonds yielding significantly more than shorter dated bonds. And that is causing a bit of a problem for equity markets at the moment.
And of course, the other thing that's causing a bit of a headache for markets and the Fed, inflation continues to make headlines.
Yes, indeed. And this is tied into the move in bond markets as inflation continues to remain elevated. It is causing a lot of angst amongst investors about how aggressive the Fed will be in its rate hiking cycle. We've already seen kind of comments from the Fed that they probably will increase interest rates another 6 or 7 times this year. Over the weekend or yesterday, US markets were open yesterday. The St. Louis Fed Chair, James Bullard, who has been perennial hawk, even suggested that the Fed may have to increase by rates by 75 basis points at an upcoming meeting. And that has triggered further weakness in bond markets, as in prices lower and yields higher. You're right, the inflation scenario continues to persist. US CPI last week came in at 8.4%, the highest in 40 years. Now, there was one bright spot in that the month-on-month increase on the core inflation rate actually increased by less than what was expected. So it is creating this debate about whether we're at peak inflation or not. But as I've said in previous commentaries, one print in inflation doesn't set a trend. So I think we need to see further readings of inflation over the coming months. And I suppose just to finish on the inflation theme, a lot of the inflation is being driven by commodity prices. Oil has been particularly volatile since the last update we gave. It's up 4% since then, and with hostilities escalating in Ukraine, the likelihood is that we will see further volatility in the commodity complex.
Indeed, and of course, oil up again this morning. So pivoting slightly to earnings season, the results due out thick and fast next week. I believe we've already heard from a couple of the US banks. What would you be looking for from companies?
Well, I think I think this week is really the start of it. As you say, there's 70 S&P 500 companies set to report earnings this week. We did see the banks report last week. Now they would be a different type of barometer for economic activity than, say, some of the more consumer-focused names, and that's really where we're looking to see the impact of higher input costs, what consumer demand is like, the end user, given the fact that we have seen a pickup in energy prices. What's that doing to consumer spending patterns? And also as well, supply chain disruptions, which have come back into the equation again with the lockdown in Shanghai. So they're the three areas that we're particularly be looking at to see how companies are able to pass on any higher input costs, what they're seeing in end demand, and what they're seeing on supply chain, which was a big headache for them last year. We've seen results just before I came online from Johnson & Johnson. They actually lowered their guidance for this year by about 25 cents on an earnings per share basis. We'll have Procter & Gamble reporting tomorrow, so that'll be another good bellwether for the basic consumer spending patterns that we're seeing, and what they're seeing in input cost inflation and how they can pass that on to the end user.
Indeed, I think we're all going to feel it in the pocket, that's for sure. So you had your weekly meeting with our institutional colleagues in MIM. Did they share any insights?
Well, our colleagues in MIM are generally quite positive on risk assets, taking a 6 to 12 month view. And I think it's very important for our clients to kind of differentiate between their strategy, which tends to be a longer term view. And indeed, from my perspective, managing discretionary portfolios, I would take a longer term view. I think for shorter term traders in the market, the caveat of the volatility that I mentioned still applies in the immediate future. But longer term, our colleagues in MIM are constructive from a number of points of view. They think that ultimately, as the Federal Reserve moves to increase rates, that it will have an impact on inflation, and they may not get to their 6 or 7 rate hikes that they're forecasting at the moment. They're also highlighting the fact that corporate balance sheets are very, very strong. You know, we saw last week JP Morgan, even though they had very mixed results, announced a 30 billion share buyback program. And there's a number of other companies in different sectors who have also increased share buyback programs. So that's very constructive from a balance sheet perspective. It shows that corporate America, and indeed most corporates globally, still remain in pretty rude health, despite the ongoing headwinds of a slightly slower economy. So overall, that gives them reason to believe that once we get through this shorter term volatile or period of volatility, that risk assets will perform in the second half of the year.
That's great. Good to know. And lastly, it feels very much like last week's news, but of course it was all over the papers with the French election ongoing, but it looks increasingly likely that Macron is going to win that election.
Yeah, there was a lot of focus on this last week after the first round poll, where Macron and Marine Le Pen from the far left came in as the two candidates that will run off in the second round elections this coming Sunday. The margin of kind of victory, if you want to call it that, in the first round was probably slightly less than expected for Macron. But opinion polls since have shown him kind of looking as if he could win it on a 54 to 46% margin. Now, that's still tight enough. I mean, he won the similar round 4 years ago, 66% to 34%. So while he is looking more comfortable than he was maybe a week or so ago, it's still a big narrowing of the gap from what it was 4 years ago. But I think markets are taking it that he probably will win by that margin. And that will certainly help the French market in particular, which has been weak on the back of the political uncertainty that's ongoing in France at the moment.
Of course, and as we know, markets do hate uncertainty. Many
Indeed.
thanks Many thanks once again, David, for your very insightful comments. Always very good to hear. I can tell you that the feedback we've been getting from clients has been very positive. And actually on that, I would like to remind everybody out there who's listening, we've got a weekly and a daily research publication that David is involved with. So if you've got any interest in receiving that, if you're not getting the report already, please do get in touch with your Cantor Fitzgerald broker. And of course, get in touch with us if you do have any other questions. Many thanks for your time, and we will see you again in 2 weeks.